Now let's discuss the preparation of consolidated financial statement at acquisition date. So on January 1, 2020, TIC Corporation acquired 80% of TOC Company's outstanding ordinary shares for 9 pesos per share. So since TIC purchased 80% of the outstanding shares and the acquisition is more than 50%, we assume that TIC Corporation obtains control over TOC Company. So since control is present, TIC Corporation is the acquirer and TOC Company is the acquiree. Since the acquirer obtains control over the acquiree, the acquisition shall be accounted for as a business combination, which is a stock acquisition. And the date where the acquiree obtains the control is January 1, 2020, which is the acquisition date. So we have a trial balance for each of the company, and these trial balance are considered to be pre-combination trial balance. Because if we will analyze each of the accounts, there is no investment in subsidiary, which means the purchase of the stocks from TOC Company's outstanding share are not yet presented in the trial balance of TIC Company. So first, let us determine the number of shares that TIC Corporation purchased from TOC Company's former shareholders. So, TOC Company has a share capital of 1,600 pesos. And this is the total par value of TOC Company with a par value per share of 2 pesos. So, how many shares were issued by TOC Company as of the acquisition date? So, the issued shares is computed as 1,600, which is the total par value of TOC Company's ordinary shares, and divided by the par value per share. So that is 800 shares. So the issued ordinary shares of TOC Company is 800 shares. And since there is no treasury share, the 800 share is also the outstanding ordinary shares. Then, out of 800, TIC Corporation purchased 80%. So the 80% is the percentage of ownership purchased by TIC Corporation. And the 80% of 800 is 640 shares. So that is the number of shares purchased by TIC Corporation from the former owners of TOC companies. So the acquisition cost per share is 9 pesos per share. So which means 640 times 9 pesos, which is the cost per share, is 5,760. And this is the acquisition cost. So let us prepare the journal entry in the books of the parent company. So the parent company is TIC Company because TIC has control over TOC Company. So in the parent's books, we will record an investment in subsidiary account by debiting investment in subsidiary for the total amount of acquisition costs, or 5,760. And since the 5,760 is paid in cash, so cash is credited also at 5,760. So this is the journal entry in the parent's books related to the acquisition of 80% ordinary shares. So after this journal entry, when we prepare the trial balance for TIC Company, the post-combination trial balance of TIC Corporation shall include an investment in subsidiary for 5,760 and the cash of TIC Company that has a pre-combination balance of 8,000 shall be reduced by 5,760. And that will be the post-combination trial balance for TIC Company. Now, after we prepare the journal entry, let us prepare now the acquisition analysis that includes the table for the determination and allocation of the excess. So for the acquisition analysis, since the acquirer purchase 80% of the acquiree's outstanding share, the acquirer shall be the controlling interest or CI. So the controlling interest has an 80% ownership, and since the ownership is less than 100, there is a remaining 20% that was not purchased by the acquirer, and that is called as the NCI or non-controlling interest. In the previous standard, the term used was minority interest. But now, the term that we use is the non-controlling interest, and the non-controlling interest has a total ownership of 20%. So the total of 80 and 20 is 100%. So now, first, let us provide the first row, which is the acquisition cost for the 80%. So the 80% acquisition cost is 5,760. So that is the amount paid by the acquirer in order to purchase the 80%. And now, since we need to determine the fair value of the NCI, which is the amount that we need to supply for this particular field, and the fair value or the total fair value of the acquiree for this particular field, we need to determine the fair value of the firm or the acquiree in order for us to determine the fair value of NCI. Because the fair value of the NCI depends on the fair value of the acquiree. The fair value of the NCI must be at 20% of the fair value of the acquiree. However, looking at the problem, there is no data about the fair value of either the NCI or the acquiree. The only information that we have on this particular row is the acquisition cost. So for this problem, we are going to assume that the 5,760 is at 80% of the fair value of the acquiree, which means that the acquirer purchased the 80% outstanding ordinary shares at fair value. So for this problem, again, we will assume that the acquisition cost that is paid by the parent to the former shareholders of the acquiree is equal to the fair value of controlling interest. So in this case, the acquisition cost is equal to the fair value of controlling interest. Of course, the fair value of controlling interest is 80% of the total fair value of the acquiree. So if 5,760 is 80% of the total fair value of the acquiree, we assume that the fair value of the acquiree is 7,200 or 5,760 divided by 80%. So if the total fair value of the acquiree is 7,200, then the fair value of NCI can be computed as the difference between 7,200 and 5,760. Or multiply 7,200 by 20%, and that is 1,440. So that is the fair value of the NCI. So in every problem, if there is no information about the fair value of either the NCI or fair value of the acquiree, our assumption is always that the acquisition cost is always at fair value of the controlling interest, unless there is an additional data that the fair value of NCI or the fair value of the acquiree is given. Because there are instances that the acquisition cost is different from the fair value of the controlling interest, because the acquirer can purchase the controlling interest at above fair value, or sometimes it can be purchased at below fair value. If it is purchased above fair value, then we have what we call the control premium. But for this problem, there is no control premium because we assume that the acquisition cost is equal to the fair value of controlling interest. So after the first row, we are going to allocate the 7,200 as to three items. And those are the book value of the acquiree's net assets, the fair value changes, and the goodwill or bargain purchase gain. So let us start with the book value of the acquiree's net assets. So the book value of the acquiree's net assets is the difference between the assets less liabilities of the acquiree. So let us determine the total asset of the acquiree. So that is stock company. So the total assets of the acquiree at book value is at 10,720 pesos. And the total liabilities of the acquiree also at book value is 4,120. So these amounts were derived in the trial balance of stock company at book value. Then, the difference between 10,720 less 4,120 is 6,600. And this is the book value of net assets of the acquiree. Or, this is the shareholders' equity of the acquiree as of this date. So the shareholders' equity is also the book value of net assets, and the balance as of the acquisition date is 6,600. So that is the amount that will be supplied under the book value of acquirer's net asset, so 6,600. And for the 6,600, let's determine the share of the non-controlling interest, and that is at 20%, or 1,320. That is computed by 6,600 multiplied by 20%. And for the share of the controlling interest, it is 6,600 times 80%, or 5,280. Now, let's determine the excess. So the excess is 480 for the controlling interest, 120 for the NCI, and 600 for the total for both controlling interest and non-controlling interest. And we call this as the excess over book value. Now, let's proceed to the fair value changes. So this is the second item. So the fair value changes is the difference between the fair value and the book value of the acquiree's assets and liabilities. So we only consider here the items of assets and liabilities of the acquiree that has a fair value that is different from the book value. So those items of assets and liabilities that has an equal fair value and book value, so those are irrelevant items and are excluded in the analysis. Based on the problem, the assets and liabilities of the acquiree that has a book value different from fair value includes inventory. The inventory has a fair value of 236 and a book value of 240 pesos. Next is land. The land of the acquiree has a fair value of 1,300 and the book value of 1,200. For the equipment has a fair value of 342 pesos and the book value is 360 pesos. The 360 pesos book value of the equipment is computed by cost of 400 less 40 pesos accumulated depreciation. So the book value of the equipment is net of the contra asset and the amount is 360 pesos. The next is the building. The building has a fair value of 1,014 pesos and the book value of 1,560, which is 1,800, the cost of the building, less its accumulated depreciation of 240 pesos. Next is the patent. The patent has a fair value of 335 pesos and the book value is 320 pesos. Then last is the bonds payable. Since we only have two liabilities and only bonds payable has a book value different from the fair value. So the fair value of bonds payable is 4,050 pesos and the book value is 4,000 pesos. So now let us compare the fair value and book value and analyze the difference. First is inventory. The difference between inventory is 4 pesos. So the 4 pesos is the difference between the fair value and book value of the inventory. So the 4 pesos is added to the 600 pesos, excess over book value. because the inventory is overvalued. So if an asset is overvalued, it means that the book value is recorded at an amount that is higher than the fair value. That is why it is overvalued. And overvaluation is added to the 600 pesos excess over book value. And why is it added? Remember that the 600 pesos excess over book value should be allocated to two items. The remaining two items is the fair value changes and the goodwill or bargain purchase gain. So between the two, the fair value changes shall be allocated first out of the 600 peso excess over book value. Then any excess shall be the goodwill or the bargain purchase gain. If the excess is positive, it will be a goodwill, and if the excess is a negative, it will be a bargain purchase gain. So how do we allocate the 600 first to the fair value changes? Let us assume that there is no fair value changes. So if there is no fair value changes, so the 600 is already the goodwill because it is positive. So the goodwill is an asset and it has a debit balance. So it will be recorded at 600 peso goodwill. However, since we have fair value changes, so the 600 should be first allocated to the fair value changes. So in this case, for example, the inventory is recorded at 240 and it has a fair value of 236 pesos, which means in the consolidated financial statement, the inventory that needs to appear is the 236, not the 240 pesos. Because in the consolidated financial statement, as of the acquisition date, all assets and liabilities of the acquiree should appear at fair value. So which means in order for the inventory to be presented at 236, which is currently recorded at 240, there should be a decrease in inventory. And inventory is reduced by crediting inventory. So inventory is credited for 4 pesos. So the debit is also at 4 pesos and the debit is goodwill. So that is why the 4 pesos is added to the 600 because the debit is goodwill, which means that the 4 pesos is being added to the goodwill of 600 pesos. Then next for land, the land has a difference of 100 pesos. So the 100 pesos is negative, which means it will be deducted from the 600. So the 600, as I said earlier, let's assume that this is already the goodwill. And the land has a book value of 1,200. However, for consolidated financial statement purposes, it must be presented at 1,300. However, this is currently recorded at 1,200, which means there should be an addition to land for 100 pesos. So that from 1,200, it will increase to 1,300. So in order to increase land by 100 pesos, the land should be debited when we prepare a journal entry. Then the credit is for 100 pesos. So if the credit is goodwill, in order for us to increase the land by debiting 100, so by crediting goodwill means we must reduce the 600 pesos by 100 pesos. So next is the equipment. The equipment has a book value of 360 and fair value of 342 pesos. So there is a difference of 18 pesos. And the equipment is overvalued because the amount recorded is higher than the equipment. So again, similar to inventory, we need to reduce the equipment by 18 pesos. And in order to reduce the equipment by 18 pesos, equipment must be credited for 18 pesos. Then our debit is goodwill for 18 pesos. Since goodwill is debited, it is added to goodwill of 600. That is why this is positive. Again, I forgot, the land is undervalued. It is undervalued because the amount recorded in the books is 1,200. However, the fair value is 1,300. Next is the building. The building is again overvalued because the carrying amount is 1,560. However, the fair value is only at 1,014 pesos. So 546. Again, we need to decrease the building. So to decrease the building, we need to credit the building for 546. And the debit is goodwill, 546. So which means if we debit goodwill, it is added to the 600. Next is patent. The patent is undervalued because the book value is only at 320. However, the current market price is at 335 pesos, which means we need to increase the patent by 15 pesos because it must be presented in the consolidated financial statements at 335 pesos. So in order to increase the patent, we need to debit the patent for 15 pesos and the corresponding credit is goodwill. So to credit goodwill means a decrease in goodwill should be recorded at 15 pesos. That is why the 15 pesos is a negative in order to decrease the 600 peso goodwill or excess over book value. Then for bonds payable, the bonds payable has a difference of 50 pesos. And the bonds payable is undervalued because it is only recorded at 4,000. However, the fair value is 4,050. So for the bonds payable, since this is a liability, the analysis is quite different compared to an asset. So for bonds payable, since the bonds payable is undervalued, and undervaluation of bonds payable requires an increase in the bonds payable because it is currently recorded at 4,000. However, for consolidation purposes, it must be presented at 4,050 pesos. So we need to increase the bonds payable. It means that for a liability to increase, we need to credit the liability account for 50 pesos. And the corresponding debit is goodwill, which is for 50 pesos. So again, if we debit goodwill, 50 pesos, it will increase the goodwill of 600. That is why this is positive 50. Now, we already analyzed the differences between the fair value and book value of the assets and liabilities of the acquiree. Now, let's determine the share of the NCI and controlling interest on the fair value changes of each item of assets and liabilities. So for inventory, the share of NCI is 1 pesos. So this is also positive, which is 20% of 4 pesos. And for the controlling interest, the 3 pesos is the 80% of 4 pesos. And same procedure for the remaining items. So that is up to bonds payable. So these are the share of the controlling interest and non-controlling interest at 80% and 20% respectively. Then let's get the total of all fair value changes. So for controlling interest, the total is 402, which is positive. So since this is positive, this is overvaluation of the net assets of the acquiree. Then for NCI, it is 101. Then the total of the acquiree is 503. So that is computed as the total of all fair value changes. And these are the overvaluation of the acquiree's net assets. Now, the 600 is now allocated for the fair value changes. So the fair value changes has a total of 503 and it will be added to the 600 peso. So the total sum is 1,103 and that is computed as the total of 600 and 503 pesos. So that same procedure for NCI, the total is 221, which is 101 plus 120, and for controlling interest, 480 plus 402 is 882. And since this row has a positive amount, these are the goodwill. So the total goodwill is 1,103. Out of this, the share of controlling interest is 882 pesos and the non-controlling interest has a share of 221 pesos. So if we are using the full goodwill approach, which is under the economic entity theory, we are going to present the goodwill in the consolidated financial statements at 1,103. However, if we are using the partial goodwill approach, which is the application of parent theory, we are going to present the goodwill at 882 pesos. So remember that under the partial goodwill approach, the share of the non-controlling interest on the goodwill should not be considered, only the parent's share. But for this problem, for this illustration, we are going to use the full goodwill approach. So which means we will present the goodwill in the consolidated financial statements, both the share of controlling interest and non-controlling interest, which is 1,103, following the economic entity theory. Now, let's prepare the eliminating entry. So the eliminating entry is not recorded in any books, whether TIC Corporation or TOC Corporation. So the eliminating entries will not appear in the books of both the acquirer and the acquiree. So in the eliminating entry, it is called eliminating entry because we need to eliminate the investment in subsidiary account that we have recorded at 5,760 acquisition cost. So in the consolidated financial statement, the investment in subsidiaries should not appear. That is why it is needed to be eliminated. As well as the elimination of the investment in subsidiary, aside from the elimination of the investment in subsidiary account, we also need to recognize non-controlling interest. Always remember that the non-controlling interest account only appears in the consolidated financial statement. Non-controlling interest is not recorded in any of the books, both acquirer and acquiree. So the investment in subsidiary account has a total amount of 5,760, and that is the acquisition cost. And the non-controlling interest that we need to present in the consolidated financial statement is at 1,440, which is the fair value of the NCI. Since we are using the full goodwill approach, which means that the goodwill that we need to present in the consolidated financial statement is at 1,103, this means that the share of the NCI in the goodwill in the amount of 221 pesos must be presented as well. So which means in order for us to present the goodwill share of the NCI, we need to present the non-controlling interest at 1,440 pesos. So now, the total of 5,760 for the investment in subsidiary and the 1,440 for the NCI is divided into three items. And as I have discussed earlier, these three items includes the book value of the acquiree's net assets, the fair value changes, and the goodwill. So let's first supply the items for the book value of the acquiree's net assets. So out of 5,760, the share of the controlling interest is 5,280, and that is part of the acquisition analysis above. So next is the non-controlling interest. Out of 1,440 non-controlling interest, the book value of the acquiree's net asset is 1,320, and the total is 6,600. If you can remember, the 6,600 is the shareholders' equity of the acquiree that we have computed a while ago. Next is the fair value changes. The share of the controlling interest in the fair value changes is 402 pesos, while for the NCI is 101, and for the total fair value changes of the firm or the acquiree is 503 pesos. So this will give us a goodwill of 882 for the controlling interest, NCI 221, and 1,103 as the total goodwill. So these are the amounts. So let's check whether the total amounts under the investment in subsidiary account will equal to 5,760. So as I highlight these three values, the sum is 5,760, and that is the total amount of investment in subsidiary that we need to eliminate. And the NCI, as I highlight these three values, the total is 1,440, which is equal to the fair value of NCI. And this is the amount that we need to recognize in the eliminating entry. Now let's start the eliminating entry first for the book value of the Aquarius net assets. So when we say book value of Aquarius net assets, what we mean here is the shareholders' equity of the acquiree as of the acquisition date. In the consolidated financial statement, the consolidated shareholders' equity that should appear includes only the shareholders' equity of the parent company, which means that the shareholders' equity of the acquiree in the consolidated financial statement does not appear, which means we also need to eliminate the shareholders' equity of the subsidiary company. And looking at the problem, the acquiree has a share capital, share premium, and retained earnings account that is included in the shareholders' equity. And these are to be eliminated in the consolidated financial statements. If you will notice, I changed a bit of the information in the problem. So I changed the date of the trial balance. So the trial balance should be as of December 31, 2019, because if you will rewind this video, the trial balance here is as of the acquisition date, which is January 1, 2020. But this is the correct date. It should be as of December 31, 2019. So now let's prepare the eliminating entry by eliminating the shareholders' equity of the acquiree. So starting with share capital. So the share capital of the acquiree is 1,600. Then, the share premium is 400 pesos. Next is retained earnings. For retained earnings, the amount debited is 4,600. However, the amount of retained earnings in the problem is 4,560. So, why is there a difference between the amount debited and the amount presented in the trial balance? Since the date of the trial balance is December 31, 2019, and the trial balance of the acquiree includes both real accounts and nominal accounts, this means that the retained earnings has not yet included the nominal accounts during 2019. Which means that the 4,560 does not include the net income or loss during the year as well as the dividend payment, because the trial balance is a pre-closing trial balance, and the 4,560 is the beginning balance of retained earnings as of 2019. So the 4,560 again is the balance of the retained earnings of the acquiree as of January 1, 2019. And we need the balance of the retained earnings as of the acquisition date, which is January 1, 2020. That's why in order for us to determine the retained earnings as of the acquisition date, January 1, 2020, we need to close the net income in 2019 as well as deduct the dividends paid in 2019. So if we consider the net income and dividends payment, the retained earnings as of the end of 2019, December 31, that will be 4,600, which is also the retained earnings as of the acquisition date, January 1, 2020. Now we're done with the book value of the acquirer's net assets. Again, always remember, the book value of the acquirer's net assets pertain to the shareholders' equity of the acquiree. Next is the fair value changes. We will going to recognize the increases and decreases in the items of assets and liabilities of the acquiree. So let's start with the inventory. So for inventory, the book value is 240 and the fair value is 236, which means it is overvalued. We need to reduce the inventory by 4 pesos. That is why inventory is credited at 4 pesos. For the land, since land is undervalued because it is recorded at 1,200 and it needs to increase to 1,300, we need to debit land for 100 pesos. While for equipment, the equipment needs to decrease by 18 pesos because it is overvalued. The amount recorded is 360 while the fair value is 342. However, for property, plant, and equipment that has a contra asset, which is the accumulated depreciation, in the eliminating entries, we need to eliminate first the amount of the contra asset in full. Because as a newly purchased entity, the acquiree, it's as if that the equipment or the PPE is also newly purchased. And if you can recall, upon purchase of an equipment or PPE, there's no amount recorded under the account accumulated depreciation upon purchase. That is why there should be no accumulated depreciation for the equipment of the acquiree that will appear in the consolidated financial statement as of the acquisition date. Because as of the acquisition date, this is the date that is considered as the purchase date. And again, as of the purchase date, for the PPE, there should be no accumulated depreciation, as if the equipment is newly purchased. That is why we need to eliminate the accumulated depreciation. So for the equipment, the accumulated depreciation is 40 pesos, and that needs to be debited at 40 pesos. And since the equipment has an undervaluation of 18 pesos, after we have debited the accumulated depreciation for 40 pesos, the equipment is left with a balance of 400 pesos. So again, after we debit the accumulated depreciation of 40 pesos, the equipment is left with an amount of 400 pesos, and it needs to be presented in the consolidated financial statement at 342 pesos, which means from 400 to 342, there should be a credit in the equipment account for 58 pesos. So 400 minus 58 is 342. And same procedure will be followed for building. So the building has an accumulated depreciation of 240 pesos. Again, the accumulated depreciation must be eliminated in full because as of acquisition date, the building is considered as newly purchased, and newly purchased PPE does not include an accumulated depreciation upon presentation on the financial statement. And since we debited the accumulated depreciation for building at 240 pesos, the building is left with an amount of 1,800. Then the building must be reduced to 1,014 pesos. That is why we need to credit building for 786 pesos, and that is the difference between 1,800 less 1,014 pesos. Next is the patent. So patent must be increased from 320 to 335 for 15 pesos. That is why patent is debited. Then for bonds payable, the bonds payable must be increased to 4,050 pesos, which is an increase by 50 pesos. So for bonds payable, there should be a credited amount. However, the amount credited is not the bonds payable account. Instead, we credit the account premium on bonds payable, 50 pesos, because we assume that the 4,000 book value is at face value, since there is no existing premium on bonds payable in the acquiree's trial balance. So that is for the fair value changes. Now, after the fair value changes, let's record the goodwill. Since we are using the total or the full goodwill approach, we need to record a goodwill of 1,103, and that will be a debit to goodwill for 1,103. Now, after we include these three items in the eliminating entry, Let's now eliminate the investment in subsidiary and recognize the non-controlling interest. So credit investment in subsidiary 5,760. So by crediting this account, this will be eliminated because the normal balance of investment in subsidiary account is debit balance. Next, we recognize non-controlling interest for 1,440, which is a credit. The non-controlling interest has a credit balance because this is part of the shareholders' equity in the consolidated financial statement. And as a part of the shareholders' equity, equity accounts have a credit balance. So I have arranged the eliminating entry. So these are all the debits that we have made, and these are all the credit because the journal entry I have prepared earlier is not organized. So of course, all debits must be grouped together as well as the amounts credited. So let's check whether the debits and credits of the eliminating entry are balanced. So for the debit, 8,098 as well as the credit side. So this is the eliminating entry as of the acquisition date. Again, eliminating entries are not recorded in either books of the acquirer or the acquiree. This is only a working paper eliminating entry. So after we prepare the eliminating entry, we can now prepare the consolidated financial statement as of the acquisition date. Now, the preparation of the consolidated financial statement starts with the trial balances of the acquirer and the acquiree. Of course, the trial balance must be post-combination trial balance. So, since this is the acquisition date, we will only use the statement of financial position. Because as of January 1, there are no nominal accounts as of the acquisition date. So, only real accounts or the balance sheet accounts. So, for TikTok, the cash is 2,240 and 6,400. The next is accounts receivable, inventory, land, equipment, accumulated depreciation, building, accumulated depreciation for building, then patent, then investment in subsidiary. So if you see, this is a post-combination trial balance. That is why there is an investment in subsidiary for 5,760. Then for cash, the cash is already reduced. If you will compare the cash balance in the pre-combination cash balance, this is already reduced. The post-combination balance of the cash account is 2,040 pesos. The next is goodwill. So though there is no goodwill yet in the trial balances of each of the company, I already included goodwill because the consolidated financial statement has a goodwill. So I already assigned a specific row for goodwill. So the total assets of both companies are 13,400 and 10,720. And this is as of the acquisition date. Then accounts payable is 150 and 120. Bonds payable. Then I already included again another account which is the premium on bonds payable because in our eliminating entry there is an account that should be recorded for premium on bonds payable. Then share capital. Next is share premium and retained earnings. Then non-controlling interest. So again, I have included non-controlling interest because the consolidated financial statements shall include a non-controlling interest, and that is under the shareholders' equity. So this is the total liabilities and equity of both the parent and subsidiary company. Now let's post the eliminating entries. So there is a debit and credit for the eliminating entry. So let's start with the inventory. The inventory has a credit for 4 pesos, then land 100 debit, then the equipment is credited at 58, accumulated depreciation is debited at 40, there is a credit to building 786 and debited accumulated depreciation for 240 pesos. The patent is debited at 15 pesos and we credited 5,760 for investment in subsidiary. So after this eliminating entry, the investment in subsidiary will be 0. Then we have debited goodwill for 1,103. Then Next is premium on bonds payable for 50 pesos. Then we debited share capital for 1,600, and that is to eliminate the 1,600 share capital of the acquiree. So this is the amount that should be eliminated. That's why this is debited. The next amount is the share premium. Again, this is debited because we need to zero out this share premium. Next is retained earnings. The retained earnings is 4,600. That is the retained earnings of the acquiree that must be eliminated. Then we credited 1,440 pesos. So that is the posting of the eliminating entries in our working paper. So these are the eliminating entries. So after we posted the eliminating entries, let's now prepare the consolidated statement of financial position. For the assets, so since the asset accounts have normal balances, so for cash, we will add 2,240 and 6,400. So that is 8,640, as well as for the accounts receivable. For the inventory, since the inventory for TIC is 300 and for TOC is 240, these are both debit balance. So this will be added and the 4 pesos must be deducted. So the inventory that will appear in the consolidated statement of financial position is 536. So basically, the formula is TIC plus TOC plus debit, because these three fields are all in debit balance, then less the credit and eliminating entry. So that is 536. Then for the equipment, we have 2,800. That is 15 plus 12 and 100. Then for equipment, that is 842. For the accumulated depreciation of equipment, it is negative 50. So if you remember that these have credit balances, and the 40 peso accumulated depreciation for the equipment of the acquiree is closed. That is why the accumulated depreciation as of acquisition date that should appear in the consolidated financial statement is the accumulated depreciation pertaining only to the equipment of the parent. So again, there should be no accumulated depreciation for the equipment of the acquiree in the consolidated statement of financial position as of acquisition date. Then for building, 3,264. And the accumulated depreciation for building is 300. Again, this is only the accumulated depreciation for the parent's building. So the 240 accumulated depreciation for the acquiree will not appear in the consolidated statement of financial position. Then the patent is 735. And investment in subsidiary is 0 because this is already eliminated. Then goodwill, under full goodwill approach, is 1,103. Then total assets is 19,010 pesos. And so this is the consolidated total assets. For accounts payable, 270. The bonds payable is 9,000. Premium on bonds payable is 50 pesos. Share capital is 2,000. Then again, for share capital, since these are all in credit balance because these are liabilities and equity accounts, and the 1,600 is debited, it means this will zero out this 1,600. That is why only the 2,000 shall remain in the consolidated balance sheet. So, and this pertains to the share capital of the parent. So as well as for the share premium, that is the share premium of the parent as of acquisition date, as well as the retained earnings. So always remember that the shareholders' equity of the parent as of the acquisition date shall appear in the consolidated statement of financial position. And part of the consolidated statement of financial position in the shareholders' equity section is the non-controlling interest, which is 1,440. Liabilities and equity in the consolidated statement of financial position is 19,010 pesos. And if you will be asked how much is the consolidated shareholders' equity, that is composed of share capital, 2,000, share premium, 500, and retained earnings 5,750, and non-controlling interest of 1,440. So the consolidated shareholders' equity is 9,690, and the consolidated liabilities is 9,320. Then the consolidated retained earnings is 5,750. So this is how you prepare the consolidated statement of financial position, and that will be the last column. So these are the procedures in the preparation of the consolidated financial statements at acquisition date. So for the year 2021, since the acquisition date is January 1, 2020, so both companies have transactions during the year 2020, and as of December 31, 2020, which is 1 year after the acquisition date, so the preparation of the consolidated financial statements 1 year after the acquisition date shall be made in a separate video.